So resilience and the ability to actually adopt and transform with the times is a fantastic thing that people can learn if they're working in an organization like that. The resilience to grow, resilience to survive in economies and geographies which have been hard, go through wars, go through famines, go through civil unrest, and still be able to create alliances, partnerships, do mergers, reverse mergers, organically grow and sustain.
Hello and welcome to this episode of the Vision Board. I am your host Saurabh Pandey, and I am honored to present Avishek Banerjee as our guest today. Avishek is the founder of a fintech platform called UPCIDE and also has a long corporate sprint across the big fours. Avishek, welcome, and we would like to start by understanding more about you and your startup.
Thank you, Saurabh. Thank you for having me today. A very good morning to you. So, Saurabh, you've already spoken. I think there's only one clarification. I've worked in 3 out of the 4 big fours. I did not have the honor of completing all the Char Dham.
Okay.
Char Dham Yatra for me has been short of 1. But beside that, yes, it's been 16 plus years that I've worked on in big fours and some years before that. So overall, about 19 years going now. So I'm one of those guys who started up after the age of 40. And what we are trying to do, Saurabh, is basically create a it's actually a wealth tech. Within fintech, you have various sub-sectors. So you have insurance, you have payments, you have brokerages. So this is about wealth management. And what we are trying to build is a platform which enables small investors to invest in large ticket physical asset deals. And the primary reason to invest in physical asset is either to get rental periodic income or to get rental plus capital appreciation, which generally happens with real estate backed assets, where you get to get terminal valuation gain as well as rental income. So that's what we're trying to build. We started off in August 2021. We're 6 months old. We're just learning how to walk. I take analogy from the kids. A little early for that though. And it's been a fantastic journey so far. I think we'll talk more about it as we go along.
Sure. I think it's very fascinating to see that, in the last 1 year alone, we have seen a surge of investments in fintech. You also started in August 2021. And what we have seen is that between the last 2 years, there is almost a 4-fold increase in investments that have come into fintech in India.
Absolutely.
We also see that India is at the forefront in terms of the consumption of fintech, platforms. The world average is about 60-65% of the population using platforms, but in India, I think it's about 80-87%. I think the only country that matches it is perhaps Brazil, but we would be either the leaders or one of the leaders in the world today. So what is happening in the last 2 years? Why is there so much of not just surge in investments, but also a surge in the fintech startups?
So sort of very, very valid question. And going back to when we started, this was one of the important reasons for us to even think through as to why we are doing this and is this the right time? Well, it's never the right time. It's always the right time for you to decide. But for us, what's happening right now is definitely something that gave us the strength of conviction to start. And you're very right. I mean, if I just look at the last 1 month, we have had about 25 odd deals in the fintech space. And anywhere between 150 to 200 crore is what has been raised. And this is from the media, which is already published. So far, sort of, if you see, banks have served to probably do lending and some bits of, they have done housing, they've done auto, they've done basic commercial lending for a long time. But what the banks have not been able to do is make the entire process very seamless, very digital first. And suddenly, I've come to this data point later, but just to give you a sense, less than 1% of India was on mobile internet when we were about 2009 and 10. 2021 ended, as per Statista, at about 61%.
Correct.
But that's a massive, massive jump in just the number of people who are literally available to you on a mobile phone. And therefore, mobile commerce, including all kinds of fintech, just boomed. Because now you can reach a complete segment which was earlier only available to you either through an email or by walking to a bank branch or maximum to an ATM, is now available to you 24/7 on the phone. And therefore, the ability to sell products, reach out to them, and actually able to convince them to participate has gone up. So you have payment technology, which is one of the largest beneficiaries of this. Lending has gone up. We have already seen what happened in 2020 and 2021. Unfortunately, with some of the microfinance guys being on digital first. Brokerage has been at it for almost a decade now. And insurance tech, regulatory tech, all of these are just booming. Regulatory tech being your compliances, whether it's a labor compliance, whether it's a shops and establishment, all of that is getting completely digital first and mobile first. So yes, it's a whole host of processes that are getting mobile first, and for the simple reason that there is a huge bunch of people who are now on mobile, and they're consuming their information as well as their commerce on mobile. And that's not a success that's happened overnight. I mean, we are seeing it last 2 years, but essentially it took a long while to happen. And now it's just that the trickle down effect, the waterfall it's huge, it's substantial.
Correct.
I mean, TRI itself has said that roughly about 4% addition to the number of people getting to the internet right now. And we still have 40% of our population who don't have a mobile phone, or at least mobile internet. So that's on the supply side. On the demand side, I think that's one reason why everyone's thought that I can reach my customer cheaper, faster. Now add to that 3-4 other things. I think all of you have understood the power of how Aadhaar has enabled KYC. That reduced the cost of acquisition of a customer substantially. Today, I mean, you can get a customer to sign up a brokerage account, a demat account, a loan account in a matter of minutes. Add to that CIBIL score, credit score, all of these governance things have just added to the convenience with which a customer can operate, the transparency with which a customer can see what's happening to his loan processing or his credit card. And there is also a substantial amount of process automation that a fintech company can provide. So all of this has just gone to add on to the ecosystem to make it so much easier. Even for us, when we started up, I mean, for us to get MSME account for ourselves or a Startup India registration, we didn't have to move outside our offices. It all happened completely digitally, completely online. So even the interface with government, opening your companies, everything. I think the only thing that we had to send someone or go somewhere physically was to get a trademark license. Everything else was completely digital. So without emphasizing further, I think a large chunk of this is because of digital penetration of internet, governance and regulatory entire ecosystem getting digital first. And one other thing which is very important to note is that suddenly from the older times when people had to go to banks or go to do the transaction physically, the number of women just increased when it came to digital. So currently, I believe 29% of all digital transactions are women originated. That's from a gender spec. But if you look at the volume, it's 40% of the total transaction as women. Now, women were someone who didn't feel very convenient to go out to these transactions, which were always in men's domain. The moment it became digital, you had a huge opening up of the gender gap, and that's That's what's adding substantially. I mean, for us at UPCIDE, in the few deals that we've done, we have 52% women who are investing. And we intend to keep it at 50% at all times. And it's been very easy. We didn't have to do anything additional to attract them. It's just digital first, so it's very convenient for them. They don't need to step out. We have mothers, working mothers who are investing with us. They have young kids. They are working from home, but they can easily invest because everything is digital. So I think if you just add all of those dots, it's a massive, massive cascading effect that has happened over the last 10 years.
Yes, no, absolutely agree with you. In fact, I think that we have just crossed the chasm. I mean, there was a time when we would be fearful of transacting on platforms like IRCTC. I mean, that was the first instance when people got an exposure towards online payments. And then you had, the e-commerce platforms come into picture. People started transacting there. They started to get comfortable with the entire process of paying online, and then this entire the payment tech started to evolve, and the user interface, the ease of use, apart from the security and trust part, and all these things put together, I think today we are at a at a place where we are easily trusting the platforms. The user interfaces, the user experiences are better, and we also have a past experience of transacting. So I think that's what is happening. Perhaps people are, and what you said, that mobile commerce over a period of time has really accelerated. That is also a definite driver towards this. I also see that a lot of banks and a lot of other platforms are becoming super apps, like Paytm or like SBI has YONO, for instance, and they are also in some ways driving the people who were on the fence to jump into it. And I think all these things are coming together.
Absolutely. I mean, the benefits outweigh any kind of concerns by multiples. I mean, even for a large organization like an SBI, it's just beneficial for them to actually invest in this, because the whole cost of operations goes down.
Right.
So you're absolutely right.
Perfect. So we see a change in behavior. What I also see, and I wanted to ask also from you, is the investment behavior of people also changing? In yesteryears, when we were to invest, we had largely two options, either real estate or fixed deposits. And we would barely hear about a teenager getting his or her own bank account in earlier days. But now I think we see a lot of these trends changing. And, how do you construe this change in behavior? Where do you see this is going?
Oh, absolutely fantastic question. So I think for us and for me, when being at an individual level, I think three things that I've seen over the last 1.5 decades. One, of course, opening up of the economy in the 90s led to one boom of individuals and retail investors or retail borrowers taking debt. That didn't happen earlier. Debt was very expensive. A large amount of household income used to go to service debt, which was mostly unstructured and taken from the market at a high rate of interest. The moment the banking sector opened up, the retail retail borrowers got a chance to take debt. The housing market opened up. Real estate took a boom. It continued to do so over cycles. There were cycles of that, but it continued. And I think real estate as an investment class just was there. I think 3 generations continuously put a lot of money in real estate. The first 2 probably did it with hard-earned money without a debt, but the last one has been doing it through debt. And not just one, maybe they have taken 2 or maybe 3, depending on their ability to service those debts. The other thing that people used to do was substantially invest in gold, which is something which was a hedge from inflation. Gold was a hedge against government absurdities, hedge against global tantrums and economies. People didn't really understand finance that well. Gold was one hedge against everything that could go bad. And so household used to put a lot of money in gold. I mean, I remember my parents would have 3 options to do investment beside the real estate. One is go for FD, and FD had 2 options, bank or post office. And incidentally, post office used to give higher returns. Then they used to do RD. so that they can put smaller ticket size into the RD. And then they used to do RD in gold with their family jeweler.
Correct.
There was no digital gold. There was no buying gold from the bank. And this is how investment happened. I think that behavior changed with my generation, where suddenly we were free to take debt, responsible and debt servicing. And obviously, the need for roti kapda makan was reduced. You could actually have a larger surplus to invest and actually look at wealth creation rather than meeting your very basic needs of life. I mean, I would very clearly say that the middle class, my parents' generation would be focused only on having a house, get the kids educated, maybe have some bits of money left to manage the rainy days. Insurance wasn't penetrating, home loans weren't penetrating, car loans weren't penetrating, but those things came with us and maybe a generation, maybe the guys who were a little older to us. And now that has changed further because the Gen Z or the millennials, as we call them, I don't think they need to care about their parents, and they need not worry about their housing either, because it's kind of taken care because of the growth in our economy and the family wealth that has grown, not consistently across all segments of our society, but most of the urban and urban sectors have people have managed significant wealth. And we as a nation do kind of save a lot of our wealth, don't waste it. And those are the benefits that our next generation is getting, and that allows them to invest differentially into other things. I mean, the whole millennial class that went after the crypto was because they had enough to actually take a risk. They were not worried about losing a few thousands or a few lakhs plus minus. They wanted to see what happened. Same thing happened with obviously the stock market over the last few years.
Right.
The entire Robin Hood phenomenon is fundamentally Gen Z, basically 25 years or maybe even 20 years to 30 years or 32 years. It's not the 35 plus who jumped in first. They did because they could afford to. So traditional investment classes need to also mature. Real estate hasn't matured as an investment class. It's still stuck at saying buy a house. Now it's more saying buy a house because the mortgage rates are very low. So please buy a house. But nobody has ever pitched saying, see, real estate can also be as beneficial an investment to a middle class, to a smaller ticket size investor as it has been in the stock market or in the mutual fund industry. If real estate can give you monthly returns, it will give you yield returns and a terminal valuation, all of that in the ballpark range of 12 to 15% IRR, you are essentially going to start competing with the mutual funds in the large cap category. So we feel that behavior is changing. The product, at least in the banking, lending, payments, insurtech, all of that is changing. We need to change the physical asset purchase and physical asset ownership patterns also. And that's exactly why we and many others like us started what we call as fractional ownership of physical assets. Right. We are still regulatorily a little back from where the world is headed. I mean, you can actually own tradable NFTs of real estate in Australia and trade it. There is a pricing mechanism which has been inbuilt so that you can actually pair your NFT of investment in one region of one commercial to one region of one residential. We still haven't got that because we still need our real estate to be transacted through the Tehsildar office or Talati office, what we call a sub-registrar office for property. So those things probably will take some time, but fundamentally creating a platform using the current regulations that are available and enabling smaller investors to invest in real estate for what we call as an alternative for FDs, an alternative for recurring deposit is what we are looking at. And I think the current market and the sentiments are very, very positive to accept that as a product. Sort of another part of alternate asset is that it's something that people have been doing on their own with their families. They have not really got into a structured, institutionalized mode of evaluating, identifying, and then actually investing in small ticket sizes and small bites on large deals. I mean, whether it's a large commercial offices, whether it is equipment leasing, These are things that have opened up, and there are reasons for that. I mean, for example, electric vehicles. Electric vehicles are something that banks are still figuring out how to invest. And the minister has been on record to ask the banks to make it a priority sector, but it's not done yet. For the simple reason that the battery life, the ecosystem of refurbishment, resale, all of that has still not come to a stage where the banks feel comfortable. And when it comes to investment platforms like us, we invest a significant amount of our personal time. We do the boots on the ground diligence. We take partners and alliances who understand battery, who understand motor, and actually understand each vehicle very quickly. Now, this in the institutionalized segment of banking or NBFC will take some time to come. But when it comes to startups and people similar to us, it's something that we are leveraging our experiences significantly to bring that very quickly to the market. And our ability to bring that to the market is augmented because of no internal processes. I mean, there is an ad going on Netflix these days of saying how quickly can you bring a product to market. I think that's where the startups have a significant edge over the traditional businesses to bring products to market very fast. And diligence, quality of diligence is improving. Uh, my team has spent significant time across the Big Four actually looking at assets, looking at audits, looking at protecting investors' money in physical assets, large capex. We have done ports, we've done significantly large oil and gas or even power plants. And then we have also done F&B, retail, and everything that requires assets. So we understand the asset life cycle, we understand why people use assets, and then we understand how to evaluate the assets. And it's all done based on ecosystem partners, alliances that can give you the product knowledge. And we do that very quickly so that we can bring the product to market, agree a term sheet with the investor, with a lessee or a landlord, and make sure these things are available to investors with a very high quality of diligence. So that's one reason why we believe that the alternate assets will start looking somewhat more favorably by the small investors, and they would also feel more comfortable diversifying. The ticket sizes have gone up, right? You can't really participate in an electric vehicle typically costing you 12.5 to 13 lakhs, maybe 15 lakhs for a four-wheeler. For you to invest it, it will be an individual investment. But for you to buy it and give it to rent, you don't know exactly what to do. But that's what we are figuring out. That's what we are tying up with a lessee who knows how to make the fleet operational. He knows how to store it in a particular hub, charge it correctly, understand what the telemetry is coming from the vehicle in terms of the battery management system data, the operator data, the driver IoT devices that are there to say how the driver is actually performing. And we build all this into our product so that this is available as an integrated data point for our investors to know out of the 100 cars that we have given to an X number fleet operator, exactly which car is doing how much and who's driving it and which is going in bad roads. And this data exists. It exists with the fleet. We are taking it, we are making it reasonably simpler to understand, and then giving it to our investor as part of their investor decks. So I think diligence and asset management, bringing a very high quality level of maturity to it. Obviously, we call ourselves institutional because we have been working with the largest private equities of the world, the largest asset owners of the world. And we bring that knowledge, that finesse in the diligence as well as asset management, and now provide it to small investors who are putting in money at one time. That's one reason we believe that alternate investment, especially physical asset-backed alternate investment, might see a significant traction from the smaller investors going ahead.
Well, absolutely makes sense. I think two keywords that I could take from your answer. One is about cryptocurrency, and other is about the regulatory part.
Right.
And I think if we put those together, the context is very clear. In the recent budget, also there was an announcement that the earnings from crypto will be taxed, but at the same time, there is no clarity on whether cryptocurrencies are, legalized or they are accepted, and that debate is persistently going on across different countries. So there is no clarity on where this is moving. How do you see this trend of cryptocurrencies, etc.?
It's a fantastic question, and it's been raging for a while. Uh, it's something that has foxed the regulators. Uh, Essentially, they did not see it coming. It's a wave, it's a tsunami in a way, that the kind of money that has flown over the last 2 years of COVID into this crypto domain across the world, not just in India. I remember sitting on at a restaurant with a bunch of people back in 2016. These were people from Far East. There was a guy from Thailand, there was a guy from Vietnam, and we were discussing crypto because that's the time when Bitcoin first hit $1,000. And our point was that let's just put in 5 beers worth of money into the crypto.
Mm-hmm.
Nobody had a clue as to what it will do. It was just a saying, there's nothing to lose.
Mm-hmm.
And I think that's something that has kind of spawned across over the last 2-3 years. Till obviously Bitcoin became too expensive, but given that most crypto exchanges allows you to invest as low as 100 rupees to get a fraction of that Bitcoin, many people like us and many youngsters like us who could afford that just jumped into it.
Mm-hmm.
The government didn't understand what's happening.
Mm-hmm.
That's my personal take. Or they thought it is a fad that will kind of die out.
Right.
Essentially, there are two parts to crypto. The one is the decentralization question of it, not letting governments control it.
Mm-hmm.
And the other is obviously the anonymous nature of it, to be able to transact anywhere in the world with the same currency. I think we have to take both separately. From what has happened in the budget, it's very clear that the government will control, and the governments across the world will control in some form or the other.
Mm-hmm.
And it will remain as a investment class rather than as a currency that will be accepted as a transaction in at least the larger economies. I mean, we cannot take some of the smaller Pan Am economies as a bellwether for the global, where the global economy is headed. And that's probably one reason why the government also wants to raise their own currency, digital currency. When it comes to taxation, I think, and much ink has been spilled over it since the budget has gone. I think that's just a deterrent. It's trying to create a deterrent for people to keep investing rather than actually telling them not to invest. Two reasons. A lot of money has already been invested. I believe 2,000 crores. I don't have the exact number with me right now, but I believe a lot of money, Indian money, is parked in crypto, and the volatility has impacted that value. I think what they're trying to do is stem the flow in a prospective way rather than to recover the retrospective investment that people have done. One thing that's happening, and it's important for us as a country to note, is that a lot of our fiat money, our basic currency, is getting parked into what we call as crypto. And if that currency is not used back in the economy, we're basically sucking out part of the GDP and parking it into an asset which has got no furtherance value of the economy. It's getting converted in dollar in some cases, can be lying in rupees. In all practical purposes, my economy's ability to churn using that money and impact the GDP is getting reduced. That to any government or any economist will be a problematic area. Because if you kind of replace that money with new printed money, my inflation is going to go up. So I believe crypto's around, it's not going to go. There is also a debate saying blockchain is a great thing, but crypto is not. I think the underlying technology of blockchain will evolve. There could be more that's coming. Ethereum is a great place that we have seen. Polygon is great. But parking our currency-backed money into an asset, it's like buying gold, right? I mean, if the gold is not tradable, you're sitting with a block of stone in your locker at home. And the only value you can get is in an exchange where some other guy is valuing it at a higher price. So the next day, if he doesn't value it, you don't have a value that the gold has.
Right.
So the same thing's happening right now. Somebody did write about it in one of the social media. It's like somebody trading in stones. There's no inherent value to it. It's just the value that is perceived between the traders.
Right.
And that's a challenge when you're actually buying that stone with real money. So I feel it's going to be around, but probably we're going to see a lot of evolution of how it's going to be used. It has become probably something that people love to hold. I think in any family meeting or any friends meeting or an ex-alumni meet of the college, if you say you're not an investor, They kind of look at you as the dark sheep. So everyone's got some bit of their fingers into those jars, but have they really understood it as an asset class? Is it something that you can actually put in your 10-year investment plan? That's a question.
Absolutely. I think that's a great visibility into cryptocurrency's future that you have provided, Abhishek. Now, so if go back to the investment part, we uh, we understand there's a change of behavior, and that people are beginning to adopt newer ways to invest. But do they also require a lot of handholding in the sense when people onboard these platforms like yours, would they require assistance and education? And I came across something called Robo advisors, uh, uh, and maybe it's one way in which to scale up the education part or onboarding part. Would you have any idea about this entire concept and how is it evolving?
So I think I will take an analogy to explain my understanding of what's happening in this space. You all probably have got private utility companies supplying you electricity and gas, piped gas if that is there. Otherwise, electricity companies, mostly privatized, send you a bill.
Mhm.
Over the years, if you look at your historical bill, it has changed a lot. You started getting data. You started getting comparative of last month, same month last year versus this month. That was the basic comparative. Then slowly they started giving advertisement. The bills have now become digital. You get it first on your email, and then because of regulatory requirements, they also send you a printout.
Mhm.
And the same thing about your credit card, right? The bills of your credit card have become far more nuanced. They tell you about your expenses. They tell you which expenses are available for EMI. They tell you how the spend is between lifestyle, between financial products, and so on and so forth. Now, all of this has been done by some form of robo. It's not a really robotic decision, but it's an algorithm-based
Right.
visualization of data analytics and data science. Taking that ahead, you will see more and more things happening. Let's take the example of the utility itself. If the utility does know where you stay, where your building is.
Right.
Based on your consumption pattern, they can easily figure out what kind of equipments are running what kind of electrical equipments are running in your premises.
Mhm.
They can tie up with local, and they can feature, and I am predicting the future is that they're going to be hyper local.
Mhm.
They're going to be also very focused on providing you services which are alliance partner services, which they still do. They give you ACs at 5-star rating. They probably give you fans from Crompton or this and that, but making it far more nuanced is what the robots will eventually do. So it's nothing but data science, which is using that data science to represent to you certain data to give you decision support. That decision support gets more and more nuanced and personalized as they get more data about it.
Correct.
And then use that personalization to also sell, upsell, cross-sell, and
Correct.
give you more things. Like today, for example, your neighbor's consumption is not known to you.
Mhm.
But tomorrow, it's a very simple data for them to say, listen, households of 3,000 square foot in this region of Delhi or Gurgaon generally is this much, and you are 20% off.
Correct.
Similarly, if you are below that and it says that, hey, participate with us on a quiz, how did you achieve that down? And you might say, I was off, I didn't stay in. So then you don't, but you say, oh, I use 5-star rating ACs, my fridge, my TV, my washing machines are all 5-star, and then they reward you in a way which is basically either monetary or kind. All of this is going to be some robot doing. There's not going to be a human doing this.
Correct.
Now
Correct.
you take that context and bring it to finance. Financials, basic financials, where your credit card statements, debit card statements, already getting some kind of data science behind it to give you those data inputs. The next will be saying, based on your experience of expenses, we believe that this is the right credit card for you versus what you're using. So the credit card companies will actually use the same data to tell you which card is better for you. Probably some fintechs are already doing it, like a credit. I'm not a member of that, so I don't know, but I believe that that's what they can easily do based on your card that you have versus what you're using that card for. They can actually tell where the more benefits lie and therefore change your card. They can change your behavior to spend also. They can see that there's some spends that you're doing in credit card can be actually better if you do it with debit card or cash. And they can tell you that this is probably better. So all of this is the evolution of the robo-advisor.
Correct.
In some state where the robo-advisor will be able to advise you on more complex nature. And it's already happening, right? If you go back and again take an analogy of Amazon, every time you buy something, there is somebody, some robot, some process that is telling you that those who bought this item has also bought this item.
Yeah, correct.
And also upsell you. If you buy 5 kg, you get more, but if you buy 10 kg, you get 2 other things, or you get something else. This is all happening automated. There's no individual sitting and doing it. This is all algorithmic. Take that in context of mutual fund investments. If you're tracking mutual fund on any of these new age mobile-based platform or even digital platforms which are web-based, it will tell you that those who looked at this share or this mutual fund also looked at these 5. Small cases are anyways coming out as a robo advice or as a celebrity advisors structure, which will keep reallocating, giving you ideas about reallocating the portfolio. Eventually, they're going to keep sending you messages to say that this is what we feel to do. Will they take away the decision from your hand? Probably not, because there's regulatory concerns around that. But will they be able to give you the advice? The answer is yes. The question that comes is how accurate and how inaccurate they are. I mean, my colleague reminded me yesterday that when Nadal was playing with Medvedev on the Australian final on Sunday, there was a time when the AI predicted 96% chance of him losing. And if I was to bet on that as an investment advice, I would have probably lost big time. So the question is, there will always be understanding of what the market. I mean, see, the flip side is, and I told my colleague, the flip side is that in 1990s there were Russian grandmasters who were beating the computer, but I don't think they can do it anymore. So there is evolution time that you can give to robo advisors if they have enough data, if they have enough processing power, and if there's enough trends that they can predict with algorithmic maturity that is coming with AI and ML. And I don't mean it as a sales pitch, but it's actually there where people are able to train the computer to ask questions and keep rectifying their errors and make it more accurate. You will probably see robo advisors telling you a lot more than just investment. I mean, there are already robo advisors telling compatibility ratio between people in your matrimonial sites. It's far more, I would believe, far more complicated than investments.
Correct. No, absolutely valid point. And talking about data science, artificial intelligence, I think we are also seeing one of the major applications is in fraud detection or anomaly detection. And while we see a surge in the fintech part, we also see that there is a potential for the fraud to increase as well. Now, how do we protect ourselves as consumers from the fraud or potential fraud that can happen? And how is the government or even the startups, what steps are they taking?
I think this has been a pain ever since we started automation, right? Back in the 90s when people were talking about automating the large insurance companies, the government-owned companies, there was an issue of data privacy. Thereafter, there was an issue of, and trust has taken time to build.
Right.
But today, if you look at what's happening, there are two parts of this conversation. One is fraud that is happening because of poor awareness and poor consumer knowledge of how to use the technology. And then there's a fraud which is happening because the technology itself was vulnerable. To my experience, and I've worked closely with some of the advisors and some of the big fours that I've worked with, cybersecurity and data privacy is a fairly large practices. At least on the enterprise side, most of the data privacy issues are either because somebody has been able to hack in or somebody internal has been allowed to hack in and use the data. And this is primarily because of data security layers that are needed have not kept up with time. People are currently trying to breach you, hack you by predicting your data. I mean, a simple theory, if you just Google, you'll find that there are password breakers, where a 8-digit password typically takes about 8 to 10 hours to break. Whereas a 12-digit password takes people, current computing power will take them 300 probably years to break, if I'm not mistaken. So, but if you check general password policies of most of the fintechs as well as some of our other businesses which are e-commerce based, you probably are good with 6 to 8-digit passwords. That's one starting point we need to start looking at, saying, how can I make it difficult for the fraudster to not commit the fraud? And this is from a technology point. If all and every password protection parameters take to 12 digits with the combination of randomization, and if randomization is available to you on your mobile app, where you can actually have randomized numbers being generated for each of your password that you have, and you have hundreds of passwords now with everything from the Book My Show to Amazon to your Netflix. For you to remember, it's very different. So typically what people do is either keep very simple passwords or keep the same password across multiple platforms. And most platforms are still asking for 6 to 8-digit passwords. Right. It just generally makes life easier for the guys who want to play around with it. So that's something that I learned very, very early in the game, that password is one of the easiest things that people are not very protective of. And this is again awareness and also some bit of investment to get that 12-digit password running, a randomization. You have RSA tokens that can help you. But all of this costs money and infrastructure, and obviously a backend that has to run. Awesome. The other issue is obviously somebody trying to phish, come through your mailers, kind of hoodwink you into clicking into a Trojan or a malware. That's not going to go away. While most of the large, and that's the reason, one of the reasons why there is significant faith and trust on a Google platform or an Apple platform, is that they have obviously kept up with the time, makes their filtration systems more better. But that's not the same case for all enterprise solutions. Most of our enterprise solutions still lack, and change is a very high cost thing, because when you keep updating your cybersecurity protocols, it takes time. Sure. With a lot of people moving to SaaS and fintech being mostly SaaS first, a lot of this will get kind of cleaned up, because if you're going on a cloud services of Amazon, Google, IBM, etc., a lot of this is being taken care at a central level by some of these folks who are fairly good at what they do. So you don't have to worry about it. And that brings us to the second part of our issue, which is frauds committed on individuals. Beside this password hack, beside the phishing. And this has happened mostly, I think, that you would probably agree, on the payment side. And this is primarily happening because people are jumping into newer technologies which make their life convenient without realizing how it can be misused. And that's where education and awareness is probably very much required. I think a lot has been done. I'm sure we all have seen ads on TVs and other different locations where SEBI, RBI, various banks have put up not to use the CVV, not to give the OTPs. I think a lot still needs to be done, because as I said, 60% of India's is on digital internet, on mobile internet, but probably 60% is not watching the TV to get that delivery. So we need to deliver this message on the apps. So like Zerodha did very recently, where risky investments, they give a nudge. They give you a data point saying this stock has not performed well, or the stuff that is there in a money control filter or a trend line filter is coming as a nudge. It says that maybe you don't want to invest in this because either the promoters have reduced their stake or the FIIs have sold. So basically giving you data point before you transact, right at the point of transaction. If somebody is doing a transaction on a platform which has been abused, I believe that's where your question is: what should platforms do? What should the technology companies do? They should be able to bring these kind of innovations in their product to help customer realize that this is probably going to be a risky investment or a risky transaction, and they should be available to know that somebody will call, somebody will ask for OTP, somebody can give you a QR code. I think there's a lot of innovation that can happen there to give the transaction point security and awareness to the consumer. The consumers are going to grow. The consumers are not going to be significantly educated and literate. It's going to take its time. I mean, if you recall, in our younger days, if I was traveling by train in the suburban trains, or if I was going by state buses, there was always a warning, "Jeb katro se saavdhan."
Right.
It was at the point of saying, "Was these are the places where pickpockets will target you." That is the most basic thing, analogy that comes to my mind of saying that I need to do it at the point of transaction. Tell customers that this can happen. For example, when you're at the ATM, while there is a lot of SMSs or mobile or even TV ad that says, don't make sure nobody's looking at your password. But right at the ATM, there is nothing that says, are you alone? Is somebody overlooking your shoulder? There's no communication to that. So those are the points at which I think at the transaction point, if we start messaging and the messages are clear, I think we'll be able to solve a lot of these frauds that are happening because of misuse of these platforms by people who are a little smarter than unfortunate consumers.
No, absolutely, I agree with you. And in fact, I also think that over a course of time, given that there would be a network effect at play across the platforms, and maybe the security and privacy, that is going to be a disruptor of network effect. So platforms that do not have enough secure environment, naturally people are going to defect from there and join platforms where the security and privacy are upheld. I think while the network part is very complex and we need to see the horizontal and the vertical parts of it, but I think in a natural course of time, I think platforms will be very serious about security.
It's also, I'm sorry, I'm taking probably a minute more to tell you that there's a lot of opportunity as well as responsibility that resides on the enterprises as well. Like for us, we are very clear that I don't want to take data that is not meaningful for me, because I have to protect it. The only data that I need to complete my regulatory and my fiduciary role is what I'll take. Correct. I don't need to know whether my investor is married or not. I don't need to know whether the investor has a kid in school or not. I don't want to know whether they want to travel abroad, how often they do. But there are so many platforms and so many other, I don't even know whether it's fintech, e-com, etc. I've come to some large insurtech, PSUs and some large aviation platforms which ask you random questions. Right. Maybe they need it for some reason, but the point is the more data you collect, the more your responsibility goes to protect.
Absolutely.
And in some cases, it's so easy to predict figure out where your resident address is. Because what they're doing is they're adding your PAN card, your Aadhaar card, your mobile number, and your address in one place. And the moment it goes, the privacy is in a very bad place. And we have had attacks, right? Over the last 2-3 years, a lot of our sensitive data, a lot of insensitive data or non-sensitive data has been disclosed. And it happened to global companies as well as domestic companies.
Sure.
So I think from an enterprise point of view, it's very, very important to be conscious of your role in collecting data, because you are taking a responsibility to protect it. And embedding data privacy, and I call it data security and privacy separately, as part of every process. Every time I'm filling a form, I'm taking a data point, my entire process should ask, why do I need this? Can I do without this? Is my business going to affect? That's the question that probably so far the enterprises, especially the digital first one, have not been asking.
Right.
I think it's time to ask that, to reduce the data we are taking, stick to what we need, and not collect all data so that we can mine it later for some other purposes, which today we don't even know.
Correct. So I think that's great insight, Avishek. Now I will wind up our discussion, but before that, I have certain questions that may be of use to our viewers as well. And one of those questions is, since you have worked in most of the big fours, what are the biggest lessons that you have learned while working there, and how have you used that learning in your current venture?
So as I said earlier, I've worked in 3 out of the 4. Substantial years in 1 and 2 of them. For an outsider, it looks like a fairly complex thing, but honestly, it's actually a lot of people keep rotating. So you see a lot of similar faces even if you move large three organizations.
Okay.
Sometimes you also see the familiar faces even if you're working abroad in different offices in the world. I think what I personally take away and I personally feel proud of is that each of these organizations, actually all of them, in some way have survived way more than some of their clients have.
Okay.
Typically, if you look at history, I think all the big fours were started somewhere in the early 1800s, between 1810 to 1845, 1850. So anything between 100 to 170, 180 years, they've all survived in some form or the other. So resilience and the ability to actually adopt and transform with the times is a fantastic thing that people can learn if they're working in an organization like that. The resilience to grow, resilience to survive in economies and geographies which have been hard, go through wars, go through famines, go through civil unrest, and still be able to create alliances, partnerships, do mergers, reverse mergers, organically grow and sustain. And their revenues have never gone down. I mean, between the four, I would suspect they're close to about 150 to $200 billion of revenue in every year. That's a significant number of revenue. That's massive revenue from a four simple business enterprises. So that's my first learning: resilience by alliance, by actually being open to change. That's at our enterprise level. That's a great learning. That's a great learning for the people down as well, because the whole culture is that we have survived and we will survive and we will build on.
Sure.
So that's the growth mentality. That's really important. That I believe is something that anybody who works will actually feel it, and those who have worked outside probably need to know about. These are all organizations which are multicultural. They are fairly a whole bunch of people across all kinds of pedagogy and pedigree that are working. The organizations who are hiring military strategists for their cybersecurity, the organizations which have hired Olympians in the human capital advisory to actually give training and talent management. They're open to imbibing knowledge and change from everywhere. So they're like sponge that is kind of taking people in, learning from them, and actually going on. And finally, it's the people. It's not necessarily that they will hire the best in class from best colleges. One filter that they have, and it's imbued in the way talent is sourced and talent is evaluated, is resilience. I think it's embedded in, I wouldn't say it's documented anywhere, but every time I was sitting in an interview or my seniors were interviewing a senior resource or a junior resource, the idea was not what you did in a college or what you did in a school or what. The idea is how often did you fail and how much did you come back and try to win again. And that's very important because an organization like a Big Four is a very high pressure, high growth organization. You need to be resilient. You need to be able to actually deliver under pressure at all times. So I think those are the 3-4 things that I take away from my 16 plus years across the field.
Absolutely. Very, very, very nice, very useful. And based on your challenges that you may have faced in your current venture, and of course your learnings, what is the advice that you are going to give to future entrepreneurs in fintech space?
I think we are also learning as we grow. So I think 3 things. One, this is a fantastic time to start. The problem still exists, some bits, but I have seen my father start up, and he's also started up in his 40s. The problems that he had versus what I faced are just not comparable. The only problem that I had was signing some 50-odd paper for a particular private sector large bank for opening my commercial account. Other than that, I don't think I would call anything as a challenge. It's been fantastic opening your company, getting it registered, getting the startup India registration, getting trademark licenses, getting your GST certificates, getting your TIN, PAN, pretty smooth. I think we are probably as good as the best in the world right now when it comes to making it easy to start up. The only thing that you need to be clear about is what is the problem that you're solving. And the second is you should know that you would be happy solving it for the rest of your life because you are creating something you may create more projects and more businesses, but at a point in time, this is the purpose of your life. We should be happy solving that problem. So that's the only thing that I believe is going to be your challenge because all the other administrative, regulatory, I think that's a brilliant place right now to be in because it's much easier to do.
Awesome. Thank you so much for your insights, Abhishek. It was wonderful talking to you today, and look forward to having an opportunity again in the future to talk to you.
Thank you so much for having me. Pleasure talking to you, and wish you a great day ahead. Thank you.